Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson and I'm joined by my partner and colleague Paul Tepsich, the founder of HYROX, who does some tremendous bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what happened last week. Our overriding theme for 2016 is that financial markets will remain volatile. January and early February saw a spike in volatility. The market settled thanks to continued central bank monetary stimulus. However, volatility is now spiking as uncertainty levels are rising on a global scale. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. At the moment, we see a growing chance of a recession in the U.S. in the next 6 to 8 months or thereabouts. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy where deflationary trends continue, leaving inflation-guided central banks somewhat perplexed. Central bank monetary policy has been at the heart of keeping volatility in financial markets lower. However, geopolitical uncertainty has taken center stage, focusing on next week's UK referendum as to whether they will remain in or leave the European Union. Bond yields continue to decline on a global scale as investors move out of more risky assets. And equity market prices are sharply lower in Europe and Asia, but still expensive in the U.S. by our metrics. With slow economic growth and low inflation, risk-adjusted returns remain below their annual averages. Okay, let's have a look at what's been driving markets over the last week. As I mentioned, volatility has jumped in the last few days and has moved above its long-term average. CNN Money's Fear and Greed Index that hit a low near 9 in January and recorded an 81 last week has moved back to the neutral level at this particular moment. And after pushing up into overbought territory, as we suggested last week, the next move was lower, and we think it could go lower still. It was a rough week for equity markets since our last webinar. Our benchmark World Equity Index is down close to 4% and is now down slightly on the year. The S&P 500 was the best performer since last Tuesday. The Euro Stock Index, the Euro Stoxx 50 Index was the worst performer. The TSX has been the best performing country index in the developed world this year, and the Canadian REIT Index has also done extremely well. After such a great performance, we have sold off most of our REIT holdings, especially in light of the anticipated weakness in the Canadian economy. Exposure to the non-online retail sector is not something that we are comfortable with at this particular moment. Now, our benchmark index tested and failed to hold the lower band of its uptrend from the lows of last February. Some further buying support may come in at near 55, but below that it could move another 15% or so lower to test the lower bands of the downtrend from May of 2015. The one-year total return has been a negative 7%, the 3-year a positive almost 5%, and the 5-year about a 5.5% return. And if you combine the equity and bond indices into a balanced scenario, the one-year total return has been a negative 2.25% for a 60% equity and 40% bond index combination. A positive 4.75 over the 3 years, and a little over 5% for 5 years. For a less risk-oriented 40% equity and 60% bond combination, the one-year total return has been flat, and about 4.60 for 3 years and around 5% for 5 years. Now, when you're comparing the return on your portfolio, don't forget to include your fees and any MER costs that might be part of that. In fixed income markets, the flight to quality has pushed safe government bonds higher and low quality issues lower. The Canadian Preferred Share Index remains in its downtrend channel. Now, this is an asset class whose prices are driven by supply and demand. Last fall, in order to draw demand for an enormous amount of new supply, Canadian banks pushed dividend yields higher. But Canadian banks will likely have more supply to come to keep up with their Tier 1 capital requirements. Now, if they raise the dividend yields again to attract buyers, any existing supply will get repriced lower as it did last fall. This has pushed up the risk level of owning these particular assets. The increased volatility in the preferred share index and the greater risk associated with them should be raising caution flags. Meanwhile, bond yields in Canada and the U.S. are telling us which way interest rates are going, and that is not higher. The relationship between bond yields and preferred shares is readjusting. Until that process has finished its adjustment, preferred shares may not be worth the added risk. Natural gas and gold moved higher this week, but oil and copper were lower. The Bloomberg Commodity Index continues its new uptrend, but is off of its recent highs. The broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. We keep a close eye on what is happening in the U.S. economy because so many of those companies are domiciled there. Let's take a quick look at the polls for the U.S. election that show that Clinton's lead has widened somewhat. And the U.S. Federal Reserve began a 2-day meeting today and will announce their latest decision on interest rates tomorrow at 2. We do not expect any change. However, there will be a press conference to follow, and financial markets will be listening very closely to what Chair Yellen has to say there. One of our recession watch metrics is focused on the relationship between the current unemployment rate and the 3-year moving average. Historically, when they intersect, a recession has followed. Now, at the moment, a recession looks to be about 6 to 8 months out into the future. Meanwhile, U.S. second quarter GDP expectations are higher after slightly better than expected retail sales data this morning. And elsewhere in the global economy, we continue to monitor global debt as it reaches record highs. And after significant monetary stimulus from the European Central Bank, the Bank of Japan, the Reserve Bank of Australia, and the People's Bank of China, the results have yet to show much economic improvement. Inflation still remains as a chief concern, and that economic growth has not really emerged. Industrial production in the Eurozone grew 2% year over year in April of this year, following a meager 0.2% rise in March and beating expectations. It is the highest increase in 3 months, boosted by a surge in the output of consumer durable goods. Now, with a little over 1 week to go until the UK referendum on remaining in the European Union, the polls are showing a jump in the Leave camp to a slim lead. If they choose to leave, it is anticipated that the UK economy could suffer for some time into the future, as well as the potential geopolitical fallout through all of Europe and the European Union itself. The British pound has been on a bit of a roller coaster ride lately, and the latest polls have pushed its value quite a bit lower. Well, Fitch Ratings on Monday lowered its outlook on the world's most indebted country to negative, saying it doubted that Japan's commitment to fixing its public finances was there. The decision makes Fitch the first credit rating agency to change its position on Japan following Prime Minister Shinzo Abe's decision to delay a rise in the consumption tax that was scheduled for April of next year. Fitch's move highlights a fierce debate about how to interpret the tax delay. Some analysts say Mr. Abe has given up on balancing the budget, while others argue the delay will help Japan escape deflation and so boost its finances in the long run. We shall continue to monitor what is happening in Japan. Now, several reports released Monday suggested pockets of relative strength in the world's second largest economy, but fixed asset investment expanded by a weaker than expected annual clip of 9.6% in the first 5 months of the year, compared with 10.5% growth in April. Even worse, the private investment portion grew by a mere 3.9% in January to May, down from an already weak 5.2% in January to April. Now, a slowdown in private investment is particularly worrisome because it indicates that companies are holding off spending, signaling limited confidence in the future and denying the economy what is often more effective and sustainable investment than government spending. And here at home, employment was little changed in May, with a number of plus 14,000. Fewer people were searching for work, and that helped push the unemployment rate down 0.2 of a percentage point to 6.9%, the lowest rate since July of 2015. Full-time employment rose by 61,000 in May, but this increase was largely offset by a decline of 47,000 in part-time. Where is all this going to take us? Well, let's see what the bond markets are telling us. Each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve, such as we see in the US, UK, and Canada, should give us some hope of better economic conditions in time, as investors want to receive greater returns to protect themselves against future inflation. But a flattening yield curve tends to signal a greater chance of recession in the not-too-distant future. Negative yields below that pink zero line indicate fear of deflation in the short term, where investors want the Okay, sorry folks, we did have some minor technical difficulties, so I'm just going to, hopefully I'm catching it where we left off, and I will continue here, starting with what happened or what we've seen happening in China. As I said, several reports released Monday suggested pockets of relative strength in the world's second largest economy, but fixed asset investment expanded by a weaker than expected annual clip of about 9.5% in the first 5 months of the year, compared with 10.5% growth through April. Now, even worse, the private investment portion grew by a mere 3.9% in the January to May timeframe, down from an already weak 5.2% in the January to April timeframe. Now, a slowdown in private investment is particularly worrisome because it indicates that companies are holding off spending, signaling limited confidence in the future and denying the economy what is often more effective and sustainable investment than government spending. Here at home, employment in Canada was little changed in May, with about 14,000 jobs added. Fewer people were searching for work, so the unemployment rate declined by 0.2 of a percentage point to 6.9%, which is the lowest rate since July of 2015. Full-time employment rose by 61,000 in May, but this increase was largely offset by a decline of 47,000 in part-time work. So where do we see all this leading us? Well, each week we look at these yield curves to assess what the bond market might be telling us. A positive sloping yield curve such as we see in the US, UK, and Canada should give us some hope of better economic conditions in time, as investors will want to receive greater returns to protect themselves against future inflation. However, a flattening yield curve tends to signal a greater chance of recession in the not too distant future. Negative yields below that pink zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection. The Japanese curve is now negative out beyond 15 years, and the German curve is negative out beyond 10 years. In essence, investors are paying to own the safety of Japanese and German government bonds because of fears of deflation. Not a good sign for either of those economies. Now, since last week, the US, the UK, the Canadian, the Japanese, and the German yield curves have all flattened, and that is not a good sign for the global economy. More specific to the US, prior to a recession, historically a yield curve will flatten, as it did in 2007. And like that gold line at the top, higher short-term yields or lower long-term yields, or a combination of both, would indicate that a recession is coming soon. So these are metrics that we continue to monitor, of course, very closely. For equity markets, investors, when they buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. Now, the 10-year average price-to-earnings ratio is 14.3 times, but the 12-month forward price-to-earnings ratio is currently at an expensive 16.8 times. Now, that's the same as it was last week, and just a little below where the equity market highs were back in May of 2015. Now, not only are prices expensive relative to earnings, but after the first quarter, there have been 4 consecutive earnings of negative earnings growth, and expectations are that the second quarter will be the 5th. And earnings growth for all of 2016 will be less than 1%. It is very difficult to expect growth in equity markets when companies cannot grow their earnings. And as we've mentioned in the past, corporate profitability, which is that gold line, tends to lead the S&P 500, the white line, with a lagged effect. And we do not see why it should be any different this time around. And of course, stock markets tend to fall during recessionary periods. So what does it all mean? Well, for the last year, we have taken a cautious and defensive posture to investing, and in light of our key theme for 2016, it has been fortuitous for our clients and ourselves. Remember that when we invest in the exact same models and securities as you do. We remain defensive because we see few, if any, good real buying opportunities at the moment. We monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain cautious. And when we are cautious, cash and cash equivalents are the best assets to own, to be defensive. So we are still carrying greater than normal cash balances in our models. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at HighRock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. Now, rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling those outperforming assets and buying the underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while the outperforming assets will ultimately underperform. This is how profitability is realized and the new cash reinvested. We also analyze each asset class to ensure that it is appropriate for each client's strategy. If an asset class like the Canadian Preferred Share Index attains a higher level of volatility and becomes less suitable, which we did discuss earlier in the show, we will reduce our exposure and your exposure to continue to maximize risk-adjusted returns. On BNN's market call a few weeks back, Paul identified 3 top picks for our models. Our clients will have exposure to these picks depending on timing and value as we see fit, and of course in keeping with your long-term strategy. In particular, the 30-year Government of Canada bonds since Paul's call have been up more than 5%, and over that short period of time, that's almost a 60% annualized return, which has been a very, very good call. Paul's with us on the call right now, and I'm just going to ask him if he has anything he'd like to add to either any of his top 3 picks updates, or perhaps any other things that might be happening in the active portfolio model.
Thanks, Scott. Yeah, that was a good move in 30-year Government of Canada bonds we bought about 5-6 weeks ago. We added to our position, and as good a move as it's been, I do think they're a tiny bit stretched, and they probably are due for a pullback, which we may get, who knows, in the back of the Fed tomorrow, and perhaps even going into next week's Brexit vote. But nonetheless, we're still bullish on longer-dated government bonds in Canada and the U.S. The Athabasca trade, that bond we bought, that too, Scott, is up around 6% since we bought it. Actually, it's up a little bit more given some of the carry we've had over the 6-week period. And that to me is still a very low-risk trade, as that bond will get called in November and refinanced by Athabasca. The other position that we made public was Conexus stock, and we are still waiting on regulators in Canada and the U.S. to approve the transaction and purchase by Superior Plus. So we're still waiting on that, and there's a little bit of upside we should have once we get converted into Superior Plus stock. So that is it for those 3 picks that we made public on TV. The rest of the tactical models specifically, we are underweight still. We're not fully invested, that is for sure, and we're going to remain that way, but we do have some very well-researched and strategic positions on it we feel are good, what we call alpha positions. They can add some value with we think we're taking a little risk. That's it.
Well, thanks, Paul. Okay, so as we do each week, let's have a peek at what news is coming. Tomorrow in the U.S., we're going to get some industrial production numbers from May, and of course the very important Federal Open Market Committee interest rate decision and conference call after, as I mentioned before. Also in the UK, we're going to see April industrial production. In the Euro area on Thursday, we're going to see May inflation, as well as we're going to get the latest interest rate decision from the Bank of England in the UK, and then we'll see the US Consumer Price Index for May as well. On Friday, we'll see the Canadian May Consumer Price Index. And then next week, pretty quiet. We'll see Japanese trade data on Sunday, and then of course the HIROC webinar will be as scheduled for next Tuesday. Okay, well that's it for today's discussion, but if there are any questions for anybody who is listening live, please feel free to ask it now. I know we have a couple of email questions that we're going to address here, and so I'm going to let Paul talk to those or ask those questions in the interim.
Okay, yeah, Scott, thanks. So we got two questions from one client, a new client, and they're both excellent questions, and to be honest, one of them I'm not extremely well versed in. So she was asking regarding the potential for a Brexit vote in favor of departing the EU. What would change? I assume she means what would change in Europe, and how would that affect our portfolios? So that's a really good question. I'll leave that with you to answer.
It is a great question. You know, it all hinges around that uncertainty factor, and the uncertainty and the potential for uncertainty is actually quite enormous, because not only will it have an impact on the UK and their economic situation, and probably for some time it will be a negative economic situation, because there will be so many things that have to be renegotiated as far as trade agreements and things like that. There's going to be a lot of uncertainty surrounding that. But on a broader scale, it also will have an impact on the entire European Union. And there is already an undercurrent of, call it concern, that the European Union may just not be able to hold. And if that happens, the uncertainty surrounding the whole European Union and even the euro as a currency becomes a question. So huge amounts of potential uncertainty if this should happen. And again, it's probably too close to call. So nobody really wants to take a particular position one way or the other because of the dramatic potential of a negative or a decision to leave the UK, to leave the European Union. So as far as client portfolios are concerned, we've already positioned ourselves for this kind of uncertainty by having significantly more cash in our client portfolios. The global equity model is about half at this juncture cash, so we've really pulled back on our exposure to global equity markets because we think that's where volatility could jump, and we've seen a little bit of it already, but it could jump even more. So we have to be very, very cautious in protecting our client capital. And so in order to do that, we've taken a very defensive posture. Now, we've taken this posture some time ago because of all the uncertainties that are out there and waiting, and certainly because it appears a lot of other investors haven't been taking that position, and they've been buying up equities recently. So just something we don't want to get involved in.
Okay, that's great. Thank you. And the second question she asked, which I think is another really good question, and we write on it or show it in the webinar and we blog on it occasionally, is why are interest rates not likely to increase, and why is there such polarizing views on whether rates are going up or down? If you like, I could probably answer that one.
Yeah, please.
I'm probably more versed in that than the European situation. So, and I did have time to prepare a little bit on this, but I certainly know it well. And I think what I would say is the first point is that there's so much structural debt. Our view, first of all, I should state our view, that we don't think rates are going to increase anytime soon. And here are the reasons why. The first is there's so much structural debt around the world right now, somewhere around 200 trillion. And pre-crisis, pre-2008, there was only about 140 trillion. So rates quite simply just can't go up because there's so much debt in place that the amount of debt and servicing that debt chokes off any potential for economic growth. It would be the same as a household having so much debt, you're financing it. You've got to pay your car loans and your mortgages, et cetera, et cetera. It's hard to actually save money. Well, it's hard for governments around the world and corporations to pay down debt for a government and or a corporation and invest new capital. So that's number one. And number two, I think, Scott, you showed it on, I think, one of the slides on the deck today. The global debt to GDP is somewhere around 240% today than it was back in pre-crisis in 2006 or 7, where it was only around 200-odd%. So again, governments are running enormous amounts of leverage. That's number two. Number three, all this monetary stimulus and fiscal stimulus has really not achieved the goals of governments and central bankers around the globe since the financial crisis, and that's really key. And I wrote about that, I think, on June 3rd on a blog. There's a couple charts up there that show the effects of 8 years of monetary and fiscal stimulus, and it really hasn't achieved the goals other than sending some asset prices higher. The other big theme, and we do talk about it a little bit, is deflation. So now what we're seeing across most certainly Europe and into Japan, and Scott shows a chart every week in the webinar, is a lot of government debt is now negative interest rates. So that is something we haven't seen in our lifetimes, that's for sure. And the reason why, the question would become, why are they negative? Like, who, for Pete's sake, would lend a government money and pay them to hold on to your money? And the question becomes, it's a matter of safety. I think Swiss 10-year bonds are at minus 50 basis points, minus 0.5%. German bonds went negative, 10-year German Bunds, they're called, went negative this morning at effectively minus 0.05 or whatever it might be, just below zero. But there is the expectation that investors need safety, and potentially there is deflation building in the world. There's certainly parts of the world. But even on our shores, we have no inflation. Wage inflation arguably has ticked up a little bit. That could be transient. Even after all the stimulus they put in, all the money supply and the monetary stimulus and the fiscal stimulus, there's still no inflation. So that inflation is the enemy of long bonds, 30-year bonds, and deflation is the friend. So long bonds to us have been telling us something for quite a while, and although we've had a pretty big rally over the past week or two, they're telling us two things. Arguably that inflation is not a concern around the world, and Scott's also said it a couple times in this webinar, that there's a potential for a recession coming. So that makes us somewhat bullish on 30-year, well, 10s and 30-year bonds. And quite frankly, to answer the last part of your question just really quickly, why are there such polarizing views on whether rates go up or down? I think it's probably because, quite simply, most people don't do the macroeconomic research that Scott and I do. We've also been trading and managing bonds for a long time. So these people probably haven't done their homework. Some people see the world a different way. Maybe they have done their homework, but they see the world a different way. I think some people domestically are just not watching what's happening across the globe. Maybe they're listening to mainstream media who talk about rates going up, and they don't talk about the interest rate curve. They talk just about the Fed may raise interest rates. Well, the Fed's only raising the overnight rate. That might affect 2-year bonds, as Scott shows, but 10-year and 30-year bonds could actually rally, and they have been doing just that over the past number of months. And our final point is, our global investors, I think, are short duration. Duration is defined as long government bonds, 30-year bonds, let's call it. You think of all those pension funds out there and insurance companies who need to do what's called immunize their portfolio, and that being they need to match the assets, the bonds they may own some stocks, et cetera, with the liabilities. Well, if your liabilities are 30, 40, 50 years into the future, you don't really want to own a pile of stocks and hope and pray that they will be able to meet your liabilities 30, 40, 50 years in the future. When you buy a government bond, you know what it'll pay you into the future. Now, it's a whole lot less than it was 10 years ago, but nonetheless, there is a demand. a natural demand always for long-dated government bonds. But the last point is, too, the demand for government debt is not just simply through pension funds and insurance companies that need to match assets and liabilities, but also baby boomers who are a very growing demographic. They're going to be the biggest demographic along with millennials, but baby boomers specifically grow for the next 30 years, that bucket, that demographic. And they need to have more fixed income in their portfolios and less volatility. And typically, stocks are defined as more volatile and more risky than fixed income. So as you age like that and hit 65, 75 years old, you need to have more fixed income in your portfolio. That's simple math. So that's the last point why there are some polarizing views. That's it, Scott.
Yeah, and I think just to add in there, as we looked at the U.S. yield curve earlier in the presentation, if the Fed does force short-term interest rates higher, they're likely going to incite a recession, which naturally pushes longer rates lower because further slowing economic growth that would take the U.S. into a recession will likely drive longer-term interest rates down. So, it becomes a self-fulfilling prophecy in a sense if that happens.
And that's exactly what's been going on lately.
Yeah. Anyway, that's great questions, and thank you for sending those in. It's great to get feedback. As I ask for every week, we want to get more and more feedback if we can. We do definitely want to cover the things that you're interested in hearing us cover. And you can email us or talk to us directly in either way to give us that kind of feedback. But as always, we do thank you for taking the time to tune in to this particular call. We do wish you an excellent rest of the week and a great weekend. And don't forget to be here next week on Tuesday. And until then, this is Scott Tomlinson signing off.